These are the most important phases of value investing ever. Their philosophies and ideas around value investing have allowed them to beat the market for a very long time. And most importantly, they have inspired millions of investors all around the world to create wealth following a principled approach anyone can follow. Stay tuned as we walk you through the history of value investing, the principles behind it, and how you can begin with your journey as a value investor. It all started in 1907, where then a young man, Benjamin Graham, and his family fell into poverty after his father's death. Feeling responsible for his family's financial situation, Benjamin Graham was determined to take his family out of poverty through investing. Graham excelled as a student, graduating at the top of his class at Columbia, finishing his degree in just 3.5 years after entering at the young age of 16 years old. Before the end of his senior year, he was offered teaching positions in 3 different departments: mathematics, English, and philosophy. Instead, he chose to support his then widowed mother by taking on a job in Wall Street. Early on, Graham made a name for himself with the Northern Pipeline Affair, an early case of shareholder activism which involved John D. Rockefeller. Graham's research indicated that the Northern Pipeline held vast cash and bond assets that he believed were not being put to good use. And he bought enough shares to force a proxy vote that would distribute these assets to the shareholders. Compared to today's standards, the stock market was a mess. There were almost no information disclosure requirements that we now know, and investors had to work with whatever information they had on companies, which at the time relied mostly on rumors and stories that people were propagating. Investors who relied on this information were often wrong, and this is because they relied on how others perceived a stock instead of the actual value of the company based on its financial results. Picture this like selecting a vacation destination just based on the brochure pictures rather than actual researching the place that you're going, the traveler's experience, and the different attractions available in the area. To avoid this issue and being able to build wealth over time, Graham developed a more systematic approach to investing that was reliable over the long run. This happened as he was working on Wall Street, and he quickly developed a set of very solid principles to buying stocks and investing. All of these principles were explained in his first book titled Security Analysis. This book provided a very clear definition of an investment, which is one where thorough analysis promises a safety of principle and an adequate return. Based on feedback from the book and his own experiences, he then perfected his ideas and added these new findings into a new book titled The Intelligent Investor. This book was a massive success, selling millions of copies worldwide and even described today by Warren Buffett as the best book on investing ever written. Following the principles that he outlined in his book, Graham managed to earn a 20% annualized return between 1936 to 1956, whereas the overall market performance for the same time was only 12.2%, meaning he beat the market average by about 8%. Some of the main principles explained in the book are the following. First, the rationality of Mr. Market and how to profit from it. Second, looking at stocks as part ownership in a business to buy them at a good price. And then third, having a sufficient margin of safety that protects you from buying stocks at too high of a price. But Graham's passion, more than investing itself, was learning a lot of things and teaching. It is said, in fact, that he taught himself 7 different languages just for pure pleasure. With this strong passion for teaching, he taught an investing class at the University of Columbia, where he shared his ideas freely with his students. Amongst all of the different students that Graham had, one in particular really stood out, and that would be none other than Warren Buffett. From a young age, Warren had a strong interest in business and investing. From starting a pinball machine business to delivering newspapers and detailing cars, Warren Buffett gathered $9,800 by the time he finished university. That's the equivalent of about $120,000 today. With his strong interest and passion for investing, Warren attended Columbia University to learn from Benjamin Graham, the man who he respected tremendously for his book and work in The Intelligent Investor. In this time period, young Warren soaked up all the lessons that he could from Graham, where he took him under his wing, mentored him, and even offered him a job after university. Buffett then launched the Warren Buffett Partnership Limited, launching his professional career as an investor, where he managed money for people through this partnership. In just 2 years, by taking an active role in his investment, Warren is said to have made 50% return for his partners. In 1962, Warren Buffett made a crucial step by purchasing Berkshire Hathaway, a struggling textile company. He later discovered, however, that the textile industry was not profitable, but then he shifted Berkshire's focus to investments. This marked the beginning of a transformation of the company into a conglomerate model, in which Berkshire Hathaway would serve as a holding company for a group of companies. But something started to happen. The issue at this time is that, unlike the past, there was more information disclosed by companies and more investors to compete with for the same deals. This meant that the approach of buying companies at very cheap prices endorsed by Benjamin Graham was no longer as effective as it once was. Companies' values were rising quickly, and buying companies at cheap prices was becoming more and more rare. This led to those companies being referred to as cigar butts by Warren.
I've been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. And that I was taught that, we'll say in 1949 or 50. It made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts and you find this on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. It's disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses.
Now, around this time, Warren met a key person in his life, and this would be the one and only Charlie Munger. Charlie was an extremely rational thinker and a very disciplined man. He spent countless hours devouring books and learning about all kinds of life topics. The two would end up becoming very close friends, and eventually Warren convinced him to leave his job as a lawyer and to join him in the Berkshire investment business. Munger was a key person in his life, and this is because he changed Warren Buffett's investment approach in one fundamental way, showing him how it is better to buy wonderful businesses at fair prices instead of fair businesses at wonderful prices. This one change was monumental to the success of Berkshire, allowing their initial stock investors to generate a return of 2,419,900% from 1965 until 2023. To put that into perspective, if you had invested only $100 in Berkshire stock back in 1965, you would have had $2.4 million today. Compare this to the $22,400 that you would have had if you simply invested in the S&P 500. With this level of success, investors all across the world, both managing investment firms and their personal investments, have made fortunes following the value investing principles that Charlie and Warren improved from Benjamin Graham. Some of these investors include the likes of Bill Ackman, Seth Klarman, and of course Joel Greenblatt. So does value investing still work? The answer is unequivocally yes. In the words of Charlie Munger, all intelligent investing is value investing. With this philosophy, countless of investors all across the world are making good investments in all kinds of stock exchanges ranging from Europe, South America, and Asia, following the principles of value investing. Now, the current principles of modern value investing include the following. First, invest in companies that you understand. Second, buy quality companies at a fair price relative to their future earnings. Third, make sure to invest with a margin of safety which will prevent you from paying too much for one particular stock. And fourth, take advantage of the irrationality taking place in the stock market. All of these principles can be followed by anyone simply by thinking rationally and staying disciplined. The story of value investing is still being written as we speak, and you can be the next successful value investor in life. To get started, we recommend reading these books. And of course, you can check out our YouTube channel where you will be able to learn the principles of value investing in a way that is easy to understand. I wish you all the best in your value investing journey, and I'll see you in the next one.